All right, ladies and gentlemen, I hope you had a wonderful day. I've been giving you the consumer videos on Thursday, but today we are going to talk macro and the next big trade. I'm talking we hit this trade and then we out to Switzerland. And no, it's not like that, okay? I was just wearing this shirt and y'all just like the passport in the thumbnail for some reason. But I do have a very crazy trade. I am going to simplify it for you, but at the end of the day, my main mission with this is to just put something on your radar and show you some of the recent developments. And given the fact that it's macro, there is going to be varying time between when we will see this materialize. Essentially, you might watch this play hit tomorrow, or it could even play out 6 to 12 months from now. I'll even tell you, I think this play has like one pump fake left in it, and I'm not talking about the bonds. So I think it's going to be a good video, and we get to talk about some recent developments, and I know some of you have been looking for some trades out there, so we're going to go over it. I will tell you the trade now, but if you would like to understand it and how it's going to be played and the simple version, you're going to want to stick around. But the play, my friends, is the Japanese yen. Now, I'll tell you, I have a position on this. If you are watching us just a week or so ago, you were probably there live when I took the trade. It was right after or around, I think, the Fed day. We made a play, and we were even talking about the whole 2001 versus 2006. Now, even since when I made that trade, there's been a lot of developments, and how things are playing out is getting interesting. So I'm already in this play, but like I said in the beginning, I just want to put this on your radar. I think it has a lot of potential, and you're about to see why when I show you what it actually compares to. And I'm sure you've probably seen the dollar lately. That has been a big story. So that's the main factor of it. It has a lot of potential, but the timing of this is finicky. And if you do remember, last year we made a video shorting the yen and talking about that because it was a lot of historic changes in a weird way. This is kind of the follow-up and now to the upside. So it relates to a lot, but like I told you, it is the Japanese yen, so hopefully you could like the video now and subscribe. And if you don't know, we give these updates on this channel every day, and we're live, youtube.com/thestockmarket. But there you go. I told you the play. It's yen to the long side, but now this is why we are looking at it now and why I think it could be something big. So we have a couple of things we need to look at. So I have the news and updates for you, and here is the Japanese yen. This is /6J. This is a futures contract on the Japanese yen. This is how I'm playing it. It's leverage on the currency. If the currency strengthens, that is how I'm making money on it. We even brought up YCL. If you remember, this is a play we've actually been bringing up over the course of the year, and you could see it. The yen strengthens, it goes up with it. But what I want you to know here and what has happened lately is that there's been a lot of Japanese data that has been showing pretty much inflation, and they haven't really been getting it. And everything from manufacturing to wages to prices and consumer behavior, it's flowing in the direction of inflation. And even though the whole entire world has experienced massive amounts of inflation, Japan and how they've operated their monetary policy over the years, they really haven't got it. So hopefully you know that Japan is a safe haven currency. It's going to come back to that, but why this is important and what this relates to recently is something called yield curve control, YCC. So what everybody has been speculating about, and this is the funny part about this trade, is when the Bank of Japan is going to exit yield curve control and start normalizing policy. It's kind of like asking when the Fed is going to stop raising rates or stop keeping rates at zero and normalize policy. The difference is Bank of Japan, they've been doing this for decades at this point, almost a decade, I guess 2015. But the moral of the story, if they get rid of yield curve control, artificially low rates, yields would go higher. Japan hasn't seen that, but what they've been waiting for is inflation to show up in the economy that has failed to produce inflation for a very, very long time. So now the whole world experienced inflation, and we finally saw last year, again, this was the play, last year we were shorting it. I think that video was around April April or May, and then you saw the yen, it hit a record low going back 20, 30 years, had to bounce a little bit with the market, and now even towards, like, remember end of last year, there was a lot of stuff going on with the yen. We're going to talk about it, but it's now been trading around here, still relatively and historically weak, but now these talks, ever since the data now in the last week, there's all of these talks about ending yield curve control. So this article came out yesterday, and the idea behind it, they were saying with all of the data, with some of the recent, they call them shunto, it's the negotiations between the labor unions and the workers or the companies. They said they're getting wage hikes, and the data is showing that inflation is passing through. All of this is what the Bank of Japan has been looking for before exiting yield curve control. They were saying the data has been flowing in the right direction, and now maybe we could start to see this. So yesterday, off of this article and the data, and they were even bringing up the recent weakness in the yen. This is why the yen went up 1%. Also, again, we had the data, the CPI, the yen reacts like we've been talking about. We've been saying it since Monday. It's kind of a pseudo bond play. The correlation between the yen and the 10-year is very large. We've actually talked about that one a lot, but this is what brought it up. And they also brought something up about the Fed. And now, before I talk to that, I'm going to have to jump back to a prior point, and it is kind of the broader thing. I want this on your radar, just like when we brought it up last year. This is important, and it relates to bonds. But the timing and trying to bet on this is a very finicky subject. Do you know how it's been, again, almost 10 years, people have been gambling on when yield curve control will get adjusted, just like OPEC and all of the rumors, like rumors of YCC ending and shooting up the yen. That happens a lot, and it always happens every time the currency gets weak. That is a common feature of the yen, so there is a chance this is short-lived, but I'm trying to point out here there's a couple of unique things happening where maybe this rumor might get legs, and if it does, with how things are looking, this play is behind everything else. Nobody else is front-running this the same. It has a lot of pressure. You're fighting Japan and all the Japan speculators, and there's a lot of stuff associated with it, but just know, it is a low-quality bet. People have been betting against this for years. It is not materialized. It's like the rich guys bet who bet against the Hong Kong dollar getting depegged. So I don't know if you heard, like, Bill Ackman and people do that, is they throw like $50 million on these options. They've done it for years, that the Hong Kong dollar will have a depeg. If it does happen, it would be the most lucrative trade ever, but it just, like, never happens, and it shouldn't happen for, like, other political reasons and economic reasons, but people still do it. So I want you to understand this isn't new, but there are these developments, and if we do watch this materialize, this could be a good turning point. And comparing it to bonds and the rest of the market now, it's a very interesting opportunity. So this was the article yesterday. It got it up, but even the day before that, around the lows, this is the next mind-blowing thing. We had an article just a couple days ago. It's just an opinion, but people have been discussing it, and this was all related to the data that's been showing that pass-through. But they're discussing how the Japanese are changing their views on price hikes, and it says it opens up the door for the policy tweak. But if you understand why Japan has been a safe haven and even how the economy has performed over the last 10, 20, 30 years, even longer, this is wild. It's pretty much saying, and what this article was discussing was that prices have gone up in Japan, and unlike other times in the past, the Japanese people are actually paying higher prices. That's where the before then they used to save money. They wouldn't. It didn't operate like that. The price hikes would always get rejected. They were always very, very prone to inflation. And that even ties into, like, the labor unions and stuff too, because not only if the people for a long time refused to spend more money, their pay, again, when it came to negotiating, it was hard to ask more money. Again, if you don't have prices going up, it's harder to justify wage hikes, and that's kind of been the problem that the Bank of Japan has been trying to deal with for the last, like, 10 years. And now it's like, well, the Japanese consumer, you're finally seeing evidence of them spending. So this was the big deal, and tying that into the data and now moving forward. But what is the play? Why is this the next big trade? Like I'm telling you, if it does lead to a shift in yield curve control, that is going to be very, very key. But Essentially, what shifting yield curve control would mean was raising rates, and that would help facilitate a stronger currency. And this is traditionally a safe haven, and it's already at like a 20-year weak point. Even I think to this day, I'll have to double check on trading economics, but still historically, it's at a very low point. So like I said, I'm playing the futures. You could play this through YCL, whatever you want. It's not a recommendation, and I think I will give you follow-ups on this. You let me know if you want, but I've been playing along with this for a while. I think it's going to show up, but here's the simple analysis, and I do have one more key point that will show you a little bit more of why this might actually happen in terms of altering YCC. But what I want you to understand, if you don't get this trade, you're like, okay, Josh, Japanese, YCC, this, that, the data, they spend money, they don't, I don't get it. Again, Japan has not raised rates at all, as everybody around the whole world has during the inflation. Again, they have not changed policy. You're like, okay, all this stuff, what does it mean? Let me show you the good old dollar. So it's very simple. What happened when we started to raise rates? In the beginning of March, I think 2022, even a little bit leading up into it as people started to anticipate it, as we started to raise rates, the currency started to shoot up. This is exactly what I'm going to be expecting for the yen if they abandon a huge policy that's been there for over 10, almost 10 years, and it is traditionally a safe haven. So I've already talked about it in the past, and we said it even when we were shorting it. Whenever the yen does come back, it's going to come back strong. It's great. Even the fact that this is like a pseudo bond play makes it that much better, because you could even play Japan and still kind of benefit on stuff that happens in the U.S. Also get hurt. I even have a little tin I guess I'll share with you, but especially related to the bonds, this is good, especially when the bond vigilantes and everybody is looking for like cut this or that and going after the bonds. I mean, the yen is in its own little world right now. So that's the upside. That's the play. That's what I'm looking for. I mean, the timing, that's going to be the only shoddy part. I'm already in it. But now the final reason why I also think this could, again, the yen could also start shooting up. I'm looking at the dollar. I got to give you a little bit more here. But it was mentioned in the article, the first one. This one, again, this was originally in Japanese too. This one's from the Nikkei, but it was talking about the interest rate differential, the spread right now between Japan and the United States. Part of the problem, part of the weakening of the currency over the last years, we kept raising rates and Japan stayed the same, even just like the 80s and the 90s, as we talked about in the first video. That, moves money in and out. So now, especially after our CPI, the PPI today, you see what the bond market's pulling forward, the rate cuts, still saying, okay, maybe one more, not two more hikes. We're going to find out, but if the Fed does actually pause, then this would actually mean you are legitimately closer to the YCC ending, because if the Fed is going to stop moving, this is the chance now to either know where the spread between Japan and the United States will stay at for some time, or if their data actually shows it and Japan starts getting the momentum right as the Fed really is going to pause, then maybe we might really get the end of YCC. So we're going to see, but that would be a very big trade if it happens. And now, I mean, let me know if you have any questions. We'll follow through. And again, none of this is a recommendation. Option trading, futures, stocks, extreme risk. You can't lose almost a financial investment. Please and sole financial advice, no purpose only. But for real, I want you to learn about the macro. I have my plays. You could always live vicariously through me and learn about it a little bit. But I'm going to end it here with a little bit of tin. So the tin related to this now is that, just think about the end of the year. Do you guys remember it was like December? I think it was right here, December 20th, December 19th with the Japanese yen. Yeah, you just got to Google it. You'll see there was people talking about the end of YCC. I think it was right here. Again, you had the meeting the next day on the 20th, but they widened the band for the yield curve control. But in the context, remember, even Powell and everybody was kind of like tripping out. The markets were weird at that time. We still didn't have our rally or anything like that. If you don't remember, during that time, even the U.S. responded to Japan. I think it was like right here. It was like in between this week, and then we had the bounce as we got into the new year. But there was a lot of surprise shifts from Japan at the end of the year. And my theory is, one working theory could be they truly were coordinating with Powell and the Fed, and as they knew Powell wasn't really ready to stop and everything else, they made their kind of turn on the dime switch and then backtrack, getting ready for the new Bank of Japan guy. But essentially, I think they were ready to move then, but America wasn't, and then they're going to be able to move right when America can, or right when America does pause. Japan's going to end that as soon as they can. That's the tin. So I don't know if it's tin theory. Call it what you want, but Chad, I hope this video helps. I hope it exposed you to something. Maybe did I say anything funny? I don't know if you smiled or was entertaining in any way, but keep this on your radar. I hope you have had an exciting week and had the long term, but let's close it out. Kick off earnings, and that's it, man. So stay hydrated, healthy, do your good. Hey, man, that's it. Macro. I'm out. Horn.